Please note, this video is based on chapters 4 and 5 of Larry Williams' book, How I Made $1 Million Last Year Trading Commodities. I will leave down below an Amazon link for the book in question. If you want to generate profits with commodity trading, then this is what you need to do. Number 1, instigate your trades when markets are range bound, i.e. when volatility is low. And number 2, instigate your trades just before volatility breakouts. A volatility breakout occurs when a range-bound market suddenly becomes a trending market. Usually, the overall conditions of a market will determine the direction of a volatility breakout. When it comes to commodity trading, we can gauge market conditions via these 3 factors. Number 1, commercial activity. Number 2, premium spreads. And number 3, open interest. Commercial activity. The term commercial activity refers to the market positioning of large corporations that need to buy and sell a commodity for their business operations. The best resource concerning commercial activity is the Commitment of Traders report, which is released by the Commodity Futures Trading Commission every Friday. Each COT report reflects data from the preceding Tuesday, i.e., it takes the CFTC around 7 business days to compile all the data for each report. However, TradingStar provides an excellent summary of COT data. I will leave down below links to the websites of the CFTC and TradingStar. Both of these resources provide you with the net positioning of the commercials with regard to futures contracts. You can also get similar data concerning large leverage speculators, such as hedge funds and retail traders. Please note that in the past, the COT report has referred to, number 1, the commercials as commercial traders and hedgers. Number 2, large leverage speculators as non-commercial traders and large speculators. And number 3, retail traders as non-reportables and small speculators. The positioning of the commercials and of large leverage traders are positively correlated to commodity prices. The positioning of retail traders is negatively correlated to commodity prices. This is because, in general, retail traders tend to be wrong about the markets. But please note that most of the time, commercial activity is a lot more influential than the activities of leverage speculators and retail traders. In order to analyze COT data for a particular group of market participants, such as the commercials, you just need to express the most recent data point as a percentile of a range for the previous 52 weeks. So for commercial activity, COT readings greater than 0.9 would be very bullish for the commodity in question. And COT readings less than 0.1 would be very bearish. Premium spreads. In order for us to talk about premium spreads, we first need to define the following quantities. C0, which equals the cash price of a commodity, which equals the price of the nearby contract, i.e. the nearest delivery date. And C1, which equals the price of the second nearest contract, i.e. the second nearest delivery date. Usually, the difference between the delivery dates in question is around 6 months. And net S, which equals the premium spread, which equals C0 minus C1. If S is negative, then we say that the commodity is in a contango environment. This is the normal state of affairs, and it is bearish for the price of the commodity. However, if S is positive, then we say that the commodity is in a backwardation environment. This occurs when there is a lot of short-term demand for the commodity or a lack of short-term supply. Consequently, this is bullish for the price of a commodity. Premium spreads can be expressed as a percentage of C0. Investing.com provides commodity prices for various delivery dates. I will leave a link to the website down below. If you would like to use premium spreads in your analysis, then you will need to start collecting data as soon as both sets of futures contracts become available for trading. Open interest. Open interest, or OI, refers to the number of outstanding contracts for a commodity. Open interest is negatively correlated to commodity prices because if lots of traders are buying, then the number of outstanding selling contracts that traders will use to close their long positions is increasing. If you would like to use open interest in your analysis, then you will need to express the current data point as a recent percentage change. When open interest increases by at least 25%, then this is bearish for commodity prices. When open interest decreases by at least 25%, then this is bullish for commodity prices. Anything outside of these two criteria equates to a no trade signal. Final thoughts. We should use our three commodity factors via a filtering framework. In other words, any trade ideas based on commercial activity should be filtered with premium spread analysis, and then these ideas should be filtered with open interest analysis. However, one could argue that a filtering approach should be prioritized as follows. Number one, the rarity of receiving a trade signal, and number 2, the ease of compiling and analyzing a set of data. Now, regarding premium spreads, backwardations are relatively rare. Also, COT data is more readily available than open interest data. Therefore, I suggest you use the following priority order for your commodity filtering system. Number 1, premium spreads. Number 2, COT data. And number 3, open interest. If you have any questions, then please either send me an email or leave a comment down below. Thank you for your time and happy trading.